Hi, and welcome to the Stockscores Market Minutes for June 20th, 2014. This week, I'm going to talk about the importance of understanding trading timeframes. The time frame of a trade determines what chart you analyze and how closely you monitor the stock. A trade may be worth taking on one time frame, but not necessarily on another. The shorter the time frame, the closer you must monitor the trade. If you have less time for the market, then you want to choose a longer time frame of analysis. Now, all of this makes more sense when we go through a real-world example. Over the last couple of weeks, the gold mining sector has started to heat up again. And you can see here we have an intraday time frame. This is a 120-minute chart going back 1 month. What that means is that each bar or candle on the chart represents 2 hours of trading, and in total we're looking at 1 month of trading action. And you can see that over the last 10 days or so we've had a pretty good upward trend for the junior gold mining sector ETF GDXJ, and of course that represents the junior gold miners primarily listed in the United States. So here we've got a group of stocks that have been doing very well over the last couple of weeks, and you can see it started with a break of a downward trend line early in June, around the 6th or 7th of June, and we've been in that upward trend since. Now the market ran away from the trend into the 12th, it pulled back to the trend, and then this week it again ran away from the trend, and on Friday it began its pullback to the trend line. So a person who has the time to watch the market intraday throughout the day would perhaps trade this trend and perhaps have bought this ETF in the $35 to $36 range and be enjoying quite a nice profit over the last couple of weeks. But not everyone has that much time. Some investors only have time to look at the market once a day perhaps, and in that case they want to analyze the daily chart. So if you can analyze the daily chart, then you'd say, well, that same trend line was broken early in June and it's rallying now up to resistance on the daily chart where it's likely going to stall at the $44 mark. I've drawn that horizontal line in red to represent what is resistance on the daily chart. But again, there are some investors who don't have time to look at the market even every day, and so they might only want to look at the market on a weekly basis. And when you look at the market on a weekly basis, you really don't see a reason to buy the junior gold miners yet, because the rally that has happened over the last couple of weeks is really taking it into resistance at the longer term downward trend line, which I've drawn here from August across the highs of February, and now we are hitting those highs again, which means it's very likely, based on a weekly chart, that this sector is going to stall here. And in fact, that's what we saw on Friday. And for the investor who can only look at the market once a week, this trade would really only be appropriate if the market can break out through that downward trend line that I've drawn in red. And so you would look at the market once a week to determine that. Some investors only want to look at the market once a month. And so you then look at the monthly chart. Here's a monthly chart of that same ETF going back to 2010. And you can see that the gold mining junior stocks have been in a downward trend since early in 2011. And it's only recently that it's been able to break that long-term downward trend line. But it still has horizontal resistance at the level in around that $44, $45 mark, just like we saw on the weekly chart. So the monthly investor would want to see a monthly close above that resistance line. That's probably not going to happen in June. It could happen in July, but probably not going to happen in June. So the time frame that you trade will depend on how much time you have for the market and just how active you want to be. And if you're a very long-term, relatively passive trader, then you're going to look at the weekly chart. If you're a much more active person that wants to watch the market throughout the trading day, well, then you're going to look at the intraday chart. And that might be a 2-minute, a 5-minute, a 13-minute, a 30-minute. Again, even on an intraday basis, how often you look at the market will determine the type of trading that you do. All right, let's take a look at the overall market now. The S&P 500 continues to be in a strong bullish channel. It's been underway since late in 2012 and really going back to 2009. But you know, I'm constantly hearing people saying, oh, the market's due for a correction. Oh, we have to be cautious. You know what? Don't worry about the market until the trend line is broken. The trend line is strong. It has not broken that trend line. We've bounced off of it in the last year and a bit, once, twice, 3, 4, 5, 6, 7 times, and it just repeatedly bounces off of that trend line. There will come a day, of course, when the market will break its trend line, and that's when it's time to worry. For now, stay bullish on U.S. stocks. Canadian market, similar in that we are in a bullish trend and really in the middle of the channel, so we still have more upside until it encounters resistance at the red line. This trend has not been underway for as long, and what we're seeing now is money rotating into some of the commodity sectors. It started with the energy sector, which has driven the Canadian market through this upward trend, and now we're starting to get a hint that money is coming into the mining sectors as well. In particular, the last couple of weeks we've seen that. TSX Venture is heavily weighted in those commodity sectors, and this week it broke a short-term downward trend line. So the outlook for the TSX Venture turned much better this week than it was last week. It's still not outstanding because this market has a big wall of pessimism to climb, but it is certainly something to watch. And if you like trading those junior commodity stocks listed on the TSX Venture, well, then you want to get up off the couch and start looking at those things again. The treasuries rallied up to resistance, have stalled there just as I've talked about for a number of weeks, and I expect that they will continue to stall. The question is whether it's going to break that upward trend line that I've drawn in green or ultimately break the downward trend line that I've drawn in red. If it breaks the green line, that means interest rates are going up. If it breaks the red line, that means interest rates are going down. And I would check this chart on a weekly basis, as I always do, to see where interest rates are going. US dollar continues to have falling tops, and this week it broke a little bit of an upward trend on that weekly chart. You can see this week's candle, the red one there, is below the previous week's close, and it's broken this little minor upward trend line from a falling top. So that is a bearish outlook for the US dollar. Gold has broken its short-term downward trend line and done so from a rising bottom. So we are starting to see some signs that investors are getting more optimistic about gold. It's still far from a good chart, however. You can see our sentiment stock score is in around the 50 mark. That's an average rating. And until we can really break this longer term downward trend line, if we draw a line across all those tops and we really can break through that, I wouldn't get too optimistic about gold, but I do think it's appropriate to start to nibble on some of these gold miners. As we did in January and February, that ultimately had a short-term rally where some of the stocks moved 30 or 40%, but then they gave it all back. Well, now we're seeing signs that these stocks are going to try again, and so you want to keep an eye on some of those gold mining stocks. Oil has broken that downward trend line. We talked about that last week and continues to be strong. This is largely related to the issues going on in the Middle East with Iraq, and that kind of thing is very unpredictable. So it could turn very quickly if all of a sudden there's some sort of peace or some resolution to the problems. Of course, knowing that those problems go back thousands of years, I don't know that that's going to happen, but still, you want to sort of realize that oil can turn very quickly if the politics in the Middle East change very quickly. The fear index is at an all-time low. Almost call this a complacency index these days. The market is very complacent about risk in the market. Not a bad thing, just realize that that also can change very quickly, because when everyone's complacent, they're not looking over their shoulder enough, and you can get a quick correction. As I said, don't worry about that until the trend line gets broken. The trend line on the stock markets continues to be strong. So I am therefore bullish on Canadian and US stocks, neutral in the long term on gold, but bullish in the short term. We are seeing some signs of optimism there, and so traders, short-term traders, can trade from the bullish side, but if you have a longer term outlook for the type of investing you do, I would still be neutral on gold. Bullish on both time frames on oil. Stocks continue to move to new highs, with recent resurgence in commodity stocks being noteworthy. Gold is strengthening, but has a tough climb against pessimism. Oil strong, but dependent on the hard-to-predict situation in the Middle East. And as I said, the TSX Venture is showing signs of life again. Well, that has been the Stockscores Market Minutes for June 20th, 2014. Have a great week in the market and trade well.